A pretty common form of exhaustion shows up when a price opens and closes relatively quietly, but during the course of the bar, it breaks temporarily above a level of resistance or below a level of support. The resistance or support in this instance could be a trend line, previous high or low, or even a reliable moving average. I call these Pinocchio bars because they give us a full sense of what's really going on. Pinocchios have three basic characteristics. Intrabar trading that pushes the price through support or resistance, but not the open or close. 2. Generally speaking, the longer the nose, the stronger the signal. And 3. Since they are essentially whipsaws, they tend to be followed by above average moves. Here's an example where the price breaks above resistance during the intrabar trading, but the open and close remain below the resistance trend line. Pinocchio bars are therefore those in which the bulk of the trading takes place outside the previous and subsequent trading ranges. This means that upside breakouts lock in unwary buyers with a loss at the closing of the bar. Alternatively, these patterns might develop because pros on the floor sense a substantial number of stops above the market. The security is then pressured as these unwary holders are squeezed out, and the price is then free to move lower. During the Pinocchio period of trading, the price moves temporarily above resistance in an uptrend or below support in a downtrend. Either buyers or sellers have a chance to push prices in their direction, but they fail. For example, if the optimists see an upside breakout, they should be attracted to the security, and the trend ought to continue. However, by the end of the bar, the price returns below the resistance and they become discouraged. The character Pinocchio tells us when he's lying because his nose gets bigger. In the case of the Pinocchio bar, it's the trading beyond the resistance or support level in question. We can also take it a step further by saying that the bigger the nose, the bigger the lie. In the case of security prices, the larger the trading range above the opening and closing prices, the more false the signal, and the greater the move in the opposite direction is likely to be. Put another way, the wider the bar, the greater the number of traders that have the potential to be locked in at losing prices. Since bearish Pinocchios represent bars in which the bulk of the trading takes place above resistance, that means above anything that can be regarded as resistance. A trend line, a moving average, a previous high, or even an emotional point on the chart, such as the high of an outside bar, and so forth. This diagram reflects the idea that when a false break develops above a downtrend line, this is also indicative of exhaustion, since the price can't hold above the strong resistance reflected by the line. Here's an example where we can see some support at these lows and connect them with a trend line. Here's the Pinocchio, which temporarily breaks below the support. Most of the trading is done below the support line, but the open and close remain above it. It's possible that there are lots of protective stops placed under the trend line, and when they've all been filled, the price is free to rally again. In addition, many bearish players may be encouraged to go short on the downside break. If that's the case by the end of the bar, i.e. the close, they're booking a loss. Since short positions are nothing more than a potential buying pool, the technical position is quite strong at this point, and prices, as we see, are free to move higher as they are fueled by these misguided shorts being forced to cover. Finally, you may have guessed that if volume picks up on the Pinocchio bar, this increases the significance of the signal. The same rule would apply, of course, to a bearish Pinocchio. This chart features the daily crude oil price. An inside day helps the price bounce off its early April low. After a few more days, it would have been obvious that the low was a bottom of some kind. Since previous lows and highs are good candidates for support-resistance zones, it would have been possible to construct a horizontal trend line at the low, indicating potential support. In fact, it was touched or approached twice around June 8th, just prior to being temporarily breached as the price experienced a Pinocchio day. After the Pinocchio, the line again acted as support. Then an outside day formed, and the price broke above a nice downtrend line, thereby confirming the Pinocchio and the outside bar. Notice that the downtrend line was touched or approached on numerous occasions, which enhanced its significance. Finally, note that the small Pinocchio that managed to temporarily break above the downtrend line in mid-May. It was initially followed by a decline, as we might have expected. However, the good news is that it enhanced the significance of the downtrend line, so when it was finally violated, a terrific rally followed. Here's a consolidation for a 10-minute bar of the S&P Composite. And here is the resistance trend line. It was followed by a breakout, but only during the interbar activity, as the open and close remained below this resistance at all times. This, of course, was a Pinocchio. We might be expecting some instant gratification on the downside, but when we look at the next bar, nothing much happens. We shouldn't be surprised that after the excitement of the Pinocchio, traders need to catch their breath. Let's see what happened next. More of the same. Now for the next bar, and once again, trading is fairly quiet, but we are moving a bit to the downside, but not the kind of above-average move that often follows a Pinocchio. At least I can construct a confirmation trend line, which has definitely been ruptured now. Finally, as I uncover the rest of the action, you can see that patience would have been rewarded on the short side. Another way of looking at this is to say, what if I went long on the breakout and did not get out when the Pinocchio was formed? If I did not have an exit strategy planned when I got in, I would probably be saying to myself that the breakout was for real and that we just needed a little bit more time. However, as time progressed and I held on during the two quiet bars, I could quite well lull myself into a false sense of security. And then, bam, the price would have fallen sharply, and I would have had to have made my trading decision to get out under duress, and that's never a good idea. The right thing to do is to make that decision on when to get out before you get into the trade. That recognizes two very important points about trading. First, there's no guarantee that the best breakout in the world is going to work. Remember, technical analysis deals in probabilities, never certainties. Second, that human nature turns to hope when things go wrong. And hope is not a strategy, it's a trap. This 30-minute Starbuck chart offers us this support line and its temporary violation. This is a Pinocchio, but it's a special one, because it's also an outside bar, and a pretty powerful one at that. Not surprisingly, prices broke above this resistance trend line, and the whipsaw action resulted in a very strong rally. Later on, we can draw this resistance trend line, and it was temporarily violated by a Pinocchio bar. I put it in quotes because this is technically not a Pinocchio, because the close is very slightly above the resistance trend line. I think it's more important to try and figure out what the underlying psychology of these charts is, rather than relying on strict rules applied to labels. This bar definitely had a bearish flavor, as pretty well all the people who bought during its development would have ended the bar with a loss. Any doubt would have been dispelled in the subsequent bar, which opened slightly above the trend line and closed well below it. This 2011 chart of staples opens with the price falling temporarily below its previous low, thereby forming a Pinocchio bar. I think myself that it qualifies more as an outside bar though, because it meets the requirements of both. Again, it's immaterial what we call it, because it's bullish price action, and that's what counts. Bullish because of the false break below the support and a rally back to take out the green resistance trend line. Talk about a positive turnaround. Later on, the price breaks below the neckline of a Head and Shoulders top, but not on a decisive intrabar basis. This Pinocchio action shows how strong the rally coming out of a failed Head and Shoulders pattern can be. If you wanted confirmation, the break above this excellent short-selling trend line provided the evidence. Summary for Pinocchio bars. A bar where intrabar trading pushes the price temporarily through resistance or support. 2. The longer the nose, the stronger the signal. 3. Heavy volume emphasizes the signal's importance. And 4. Pinocchios sometimes have double characteristics that qualify them for other bars, such as the outside variety.